beloved seekers of timeless wealth, dear family of patient builders and visionary thinkers, there exists a question that has haunted investors for generations. A question whispered in boardrooms and debated in financial circles. A question that separates those who build lasting fortunes from those who merely chase fleeting gains. THEEDRNLCRH, how do you identify the stocks you can own forever? The business is so exceptional, so enduring, so fundamentally sound, that you never need to sell them, that you can pass to your children, that compound wealth across generations. This is not about finding the next hot stock. This is not about momentum trading or technical analysis or market timing. This is about something far more profound, something far more powerful, something that, once understood, transforms you from a trader into an owner, from a speculator into a wealth builder. Let me tell you something that will change how you think about investing forever. The greatest wealth in history has not been created by buying and selling. It has been created by buying and holding, by identifying exceptional businesses and never letting them go. Think about it. If you had bought shares in Coca-Cola in 1919 and simply held them, reinvesting dividends, doing nothing else, your descendants would be extraordinarily wealthy today. Over a century of compounding, through world wars, through depressions, through countless market crashes, the business endured, the wealth compounded. Or consider this. If you had identified Berkshire Hathaway in 1965 when it was a struggling textile company being transformed into an investment vehicle, and you had simply held, your investment would have compounded at nearly 20% annually for 6 decades. 6 decades. A $5,000 investment becoming over $100 million. This is the power of identifying businesses you can own forever, not just for years, not just for decades, but for lifetimes, for generations, forever. But how? How do you identify these rare, exceptional businesses? How do you distinguish them from the thousands of companies that will fade into irrelevance? How do you develop the judgment to recognize quality that endures? That's what we're going to explore today. Not through formulas or checklists, though we'll discuss practical criteria, but through understanding, through developing the mental frameworks, through learning to see what most investors miss. Let me start with a story. A story about a mistake I made early in my investing career. A mistake that taught me more about identifying forever stocks than any success ever could. I was in my 30s, still learning, still making errors, and I bought shares in what appeared to be an exceptional business, a technology company, growing rapidly, dominant market position, excellent management, everything looked perfect on the surface. I held those shares for 3 years, watched them appreciate nicely, felt smart about my investment. And then the business model changed, technology evolved, competitors emerged with better products, and within 5 years, that dominant company was struggling. Within 10 years, it was gone. I had confused a temporarily successful business with a permanently exceptional one. I had mistaken present dominance for enduring competitive advantage. I had failed to ask the most important question: will this business still be thriving 20, 30, 50 years from now? That experience taught me something fundamental, something that has guided every investment decision since. The businesses you can own forever, they possess certain characteristics, certain qualities that transcend time and circumstance. And learning to recognize these qualities, that's the secret. The first quality, and this is absolutely fundamental, is a durable competitive advantage, what investors call a moat, a protection against competition that doesn't erode over time. That gets stronger, not weaker, as years pass. But here's what most people misunderstand. They think any competitive advantage qualifies. They see a company with high market share or strong brand recognition and assume that's enough. It's not. True durability, the kind that allows you to own a stock forever, requires advantages that are essentially permanent, that cannot be competed away through innovation or disruption or changing consumer preferences. Let me explain through examples. What are permanently durable advantages? Network effects. When a product becomes more valuable as more people use it. Think about credit card networks. The more merchants accept Visa, the more valuable it is to cardholders. The more cardholders use Visa, the more valuable it is to merchants. This creates a self-reinforcing cycle that's nearly impossible to break. Someone starting a competing credit card network today would face an insurmountable challenge. They'd need to convince millions of merchants and billions of cardholders to switch simultaneously. It's not happening. The network effect is permanent. Or consider switching costs. When changing from one product to another is so expensive, so time-consuming, so risky, that customers simply don't do it. Think about enterprise software. A large bank using a particular core banking system, they're not switching ever. The cost and risk are too enormous. The disruption would be catastrophic. This creates permanent customer retention, permanent recurring revenue, permanent competitive advantage, or think about cost advantages from scale. When being largest gives you structural cost advantages that smaller competitors cannot replicate. Walmart can operate on profit margins that would bankrupt smaller retailers because their scale gives them negotiating power, logistics efficiency, technology amortization that others cannot match. These advantages, network effects, switching costs, scale economies, they're durable. They strengthen over time. They protect businesses for decades. But temporary advantages, technological superiority, brand preference based on fashion, first mover advantage, these erode. Technology gets copied or superseded. Fashion changes. First movers get overtaken. These are not foundations for forever stocks. So the first question you must ask about any potential forever stock is, does this business possess a truly durable competitive advantage? Not just a current advantage, but one that will still be protecting it in 2050, in 2070, in 2100. If you cannot confidently answer yes, if there's any doubt it's not a forever stock, move on. The second quality is operating in an industry that will still exist and matter in 50 years. This sounds obvious. It's not. Most industries that seem permanent eventually become obsolete or dramatically diminished. Newspapers seem permanent for centuries. Now they're dying. Typewriters seemed essential. Now they're museum pieces. Video rental seemed like it would last forever. It lasted 2 decades. The businesses you can own forever must operate in spaces that serve fundamental, unchanging human needs. Not wants, not preferences, needs. People will always need to eat. So food and beverage companies serving unchanging preferences, those can be forever stocks. Coca-Cola sells the same product it sold a century ago because the desire for sweet, refreshing beverages is timeless. People will always need health care. So pharmaceutical companies with patent, protected drugs, and medical device companies with switching costs, those can endure. People will always need insurance, financial services, basic consumer goods infrastructure, energy in some form, though the sources may change, but businesses serving temporary needs, technologies that will be superseded, luxury goods dependent on fashion. These are not forever stocks, no matter how strong they appear today. So ask yourself, in 50 years, will people still need what this business provides? Will the fundamental value proposition still matter? If technology changes, if consumer preferences evolve, if economic conditions shift, will this business still be relevant? If you hesitate, it's not a forever stock. The third quality is exceptional management with integrity. This is harder to evaluate than competitive advantages or industry dynamics. But it's equally important, perhaps more important, because businesses evolve, industries change, competitive landscapes shift, and how a company navigates these changes, that depends entirely on the quality of management. Forever stocks need management teams that think long-term, that resist short-term pressures, that allocate capital brilliantly, that adapt to change without compromising core principles, that treat shareholders as partners, not as marks to be exploited, and most critically, management with integrity, because without integrity, even the best business eventually destroys itself, through accounting fraud, through excessive risk-taking, through empire building that benefits management at shareholders' expense. I've watched exceptional businesses destroyed by poor management. I've seen durable competitive advantages squandered through bad capital allocation. I've seen shareholder value extracted by executives enriching themselves. And I've learned that no business, no matter how wonderful, is worth owning forever if management lacks integrity or long-term orientation. So how do you evaluate management? Not through interviews or presentations. Those are performances. You evaluate through actions over time. Do they allocate capital well? Do they buy back stock only when it's undervalued? Do they make acquisitions that create value or that simply build empires? Do they invest in the business for long-term strength even when it hurts short-term earnings? Do they treat shareholders fairly? Are executive compensation packages reasonable or obscene? Do they communicate honestly about both successes and failures? Do they follow through on commitments? Do they demonstrate long-term thinking? Do they resist pressure to maximize quarterly earnings at the expense of sustainable value creation? Do they invest in research development, employee development even when Wall Street wants them to cut costs? These questions, answered through studying years of actions, decisions, communications, reveal management quality. And management quality determines whether a business you could own forever actually remains a business you should own forever. Let me tell you about a business I've owned for over 30 years. A business that exemplifies these qualities. I won't name it. That's not the point. The point is understanding what makes it a forever stock. It operates in an essential industry, one that serves fundamental human needs that haven't changed in centuries and won't change in centuries more. It possesses enormous competitive advantages, scale advantages, network effects, brand strength built over more than a century. But what makes it truly exceptional is management. 3 decades of watching them allocate capital, resist short-term thinking, invest for the long term, treat shareholders as partners, communicate with honesty even when the news is bad. I've never sold a single share. I've reinvested every dividend, and that investment has compounded at rates that seem impossible. Not because I was brilliant, but because I identified a business I could own forever, and then I owned it forever. That's the power of this approach. That's what we're really talking about. Not finding stocks that will double next year, but finding businesses so exceptional that you never need to sell them, that compound wealth across your lifetime and beyond. Now that you understand the foundational qualities, let me take you deeper. Because identifying forever stocks is not just about checking boxes. It's about developing a sense, an intuition built on deep understanding, a way of seeing that penetrates beyond financial statements into the essence of what makes a business truly enduring. The fourth quality you must seek is pricing power, the ability to raise prices without losing customers. This might be the single most important characteristic of a forever stock, because inflation is eternal. Costs rise over time, always, inexorably. And if a business cannot raise prices to match rising costs, its margins compress, its profitability erodes, its value diminishes. But businesses with true pricing power, they not only maintain margins, they expand them. They grow more valuable even in inflationary environments. They compound wealth in real terms, not just nominal terms. So how do you identify pricing power? You look at history. Has this business raised prices consistently over decades? Have customers continued buying despite those increases? Have competitors been unable to undercut on price? Think about luxury brands. Hermes has raised prices annually for decades. Their customers don't care. They buy more, not less. That's pricing power. Or consider Coca-Cola. The price of a Coke has risen thousands of % over a century. People still buy it. That's pricing power. But commodity businesses, they have no pricing power. Oil companies can't charge more than market rates. Steel makers compete purely on price. Agricultural producers take whatever the market gives them. These businesses might be good investments at the right price, but they're not forever stocks because they lack this essential quality. Here's a simple test. Ask yourself, if this business raised prices 10% tomorrow, would customers revolt? Would they flee to competitors? Would volume collapse? If yes, no pricing power. Not a forever stock. If no, if customers would grumble but keep buying, that's pricing power. That's a business you can own forever. The fifth quality is capital light operations. This is subtle. Most investors miss it, but it's crucial for true forever compounding. Some businesses require constant capital investment just to maintain their position. Airlines must replace planes. Steel makers must upgrade furnaces. Retailers must renovate stores. These businesses can be profitable, but they consume cash. They cannot compound at high rates because so much capital must be reinvested just to stand still. But capital-light businesses, they generate cash far in excess of maintenance requirements. Software companies, payment processors, asset-light manufacturers who outsource production. These businesses can compound value at extraordinary rates because capital requirements are minimal. Let me illustrate with 2 businesses, both highly profitable, both dominant in their industries. Business A is a traditional manufacturer. It generates $1 billion in annual profit. but it must invest $800 million annually in new equipment, facility maintenance, technology upgrades just to maintain current production capacity. Free cash flow is $200 million, good but not exceptional. Business B is a software company. It also generates $1 billion in profit, but its capital requirements are minimal, perhaps $50 million for servers and development tools. Free cash flow is $950 million. Nearly all profit converts to cash that can be reinvested or returned to shareholders. Over decades, which business compounds faster? Business B, dramatically faster, because it can deploy that cash into growth, acquisitions, buybacks, dividends, while business A must constantly feed the machine just to maintain position. This is why technology and service businesses often make better forever stocks than capital-intensive businesses. Not always. There are exceptions. But capital efficiency matters enormously for long-term compounding. So look at a business's capital requirements. How much must they spend just to maintain current operations? How much free cash flow do they generate relative to earnings? The higher the conversion of earnings to free cash flow, the better the forever stock. The sixth quality is simplicity. This surprises people. They think complex businesses must be better, more sophisticated, more defensible. But the opposite is true. Simple businesses are understandable, predictable, easy to evaluate. You can project their future with reasonable confidence because you understand what drives their success. Complex businesses are opaque, full of moving parts, dependent on factors you cannot understand or predict. And what you cannot understand, you cannot confidently hold forever. I'll give you a principle I've followed for 50 years. If I cannot explain a business to an intelligent 12-year-old in 5 minutes, I don't invest in it. Because if I can't explain it simply, I don't understand it well enough to own it forever. Coca-Cola is simple. They make syrup. They sell it to bottlers worldwide. The bottlers make beverages. People buy them. Simple, predictable, understandable. A complex derivatives trading operation. I cannot explain that simply because I don't fully understand it. The risks are opaque. The outcomes are unpredictable. That might be a profitable business. But it's not a business I can own forever because I cannot understand it deeply enough. This principle has saved me from countless mistakes. It has kept me in businesses I understand and out of businesses I don't. And over decades, that has made all the difference. So before you commit to owning a stock forever, ask yourself, can I explain this business simply? Do I understand how it makes money? Do I understand what makes it successful? Do I understand what could go wrong? If the answers are yes, simple, clear, obvious, it might be a forever stock. If the answers are complex, unclear, dependent on many factors, move on. You cannot own forever what you cannot understand deeply. Now let me talk about something that most investors get exactly backwards. The relationship between growth and quality in forever stocks. Most investors seek high growth. They want businesses growing revenue 20, 30, 40% annually, and they assume that growth equals quality. That faster growing businesses are better forever stocks, but this is often wrong, sometimes completely wrong, because high growth often indicates a business that's still establishing itself, still unproven, still vulnerable. The competitive advantages aren't yet secure. The business model isn't yet validated across cycles, and high-growth businesses attract competition. Like blood in the water attracts sharks. When everyone sees rapid growth and high returns, they enter the market. They compete away the excess returns. They erode the advantages. But mature businesses growing slowly, 5, 7, 10% annually, these often make the best forever stocks, because their slow growth indicates stability, established competitive advantages, markets that aren't attracting destabilizing competition. And here's the magic. A business growing at 7% annually with sustainable competitive advantages, held for 50 years, compounds into extraordinary wealth. You don't need spectacular growth, you need sustainable growth, reliable growth, growth that continues year after year after year. Think about the businesses that have been owned successfully for generations. They're rarely the fastest growers. They're the steady growers, the reliable growers, the businesses that compound at good but not spectacular rates for decades. So don't chase growth. Seek sustainability. Seek reliability. Seek businesses that will still be growing at reasonable rates in 30 years. That's what creates forever stocks. Let me tell you about a realization that changed how I invest. It came to me about 20 years into my investing journey. I was reviewing my portfolio, looking at what had actually created wealth over 2 decades. And I made a discovery. The stocks that had made me the most money. They weren't the ones that had the most exciting stories. They weren't the ones that grew fastest in any single year. They weren't the ones that got the most attention. They were the ones I'd forgotten about. The ones I bought and then ignored for years. The ones I owned so long they became boring. The ones that just quietly compounded year after year while I focused elsewhere. A utility stock I'd bought in my 30s and ignored for 15 years. A consumer staples company I'd purchased and never thought about again. An industrial company that did nothing exciting but printed money reliably for 2 decades. These boring stocks, these forgotten holdings, they had massively outperformed my exciting investments. The ones I'd traded actively. The ones I'd watched closely. The ones I'd thought about constantly. Why? Because the forever stocks don't need attention, don't need management, don't need trading, they just need time. And the ability to be forgotten allows them to compound undisturbed. This taught me something profound. The best investment is often the one you can ignore. The business so sound, so stable, so reliable that you never need to check on it. That you can own for 20 years without looking at the price once. If you're checking a stock price daily, it's probably not a forever stock. Forever stocks are boring. They're forgettable. They're the investments you make, and then forget about while they quietly make you wealthy. Now let me address something that confuses many investors, the relationship between valuation and forever stocks. Because many people think if it's a forever stock, price doesn't matter. If I'm holding forever, I can pay any price. This is dangerously wrong. Even the best business in the world becomes a bad investment at the wrong price. Even a stock you can own forever becomes a mistake if you overpay dramatically, because valuation determines your return. If you pay 50 times earnings for a business that grows earnings at 10% annually, your returns will be mediocre even if you hold forever. The mathematics don't work, but if you buy that same business at 15 times earnings, your returns compound beautifully. Same business, same growth, radically different outcomes based purely on purchase price. So finding forever stocks is only half the equation. Buying them at sensible prices is the other half, and this requires patience, requires waiting, requires the discipline to let wonderful businesses pass by if they're not available at reasonable valuations. I've identified many forever stocks that I've never owned, businesses I'd love to own, that I've watched for decades, that I know intimately, but I've never bought because the price was never right. The valuation was always too high, and I had the discipline to wait. Some of those I eventually bought when prices became reasonable. Some I never bought, and that's fine. That's good investing, because owning a wonderful business at a terrible price is worse than not owning it at all. So here's the framework. First, identify businesses with the qualities we've discussed. Durable competitive advantages, essential industries, great management, pricing power, capital efficiency, simplicity, sustainable growth. Second, wait for reasonable valuations. Not bargain prices necessarily, but reasonable prices. Prices where the mathematics of compounding work in your favor. Where you're not paying so much for future growth that you need everything to go perfectly. And third, when both conditions align, when you find a forever stock at a reasonable price, buy it. Meaningfully, with conviction. And then never sell it. Hold it for decades, for your lifetime, for your children's lifetime. That's how generational wealth is built. Not through trading, not through timing, but through identifying exceptional businesses at reasonable prices and then having the wisdom to leave them alone. Let me share one more insight, one that's perhaps most important of all. The insight about what you're really buying when you buy a forever stock. You're not buying a ticker symbol. You're not buying a number on a screen. You're buying a piece of a business, an ownership stake in a real enterprise that employs real people, serves real customers, creates real value. And when you think like an owner rather than a trader, everything changes. You stop caring about daily price movements. You stop worrying about quarterly earnings beats. You stop reacting to news and rumors. You start asking owner questions. Is this business creating value? Is management allocating capital well? Are competitive advantages strengthening or weakening? Is the long-term trajectory positive? These are the questions that matter. These are the questions that determine whether a business you can own forever should be owned forever. And when you find a business where the answers to these questions remain consistently positive year after year, decade after decade, you found something precious, something rare, a genuine forever stock, a parrot 30 HDIC Polaning OF4 Now we arrive at perhaps the hardest part, not identifying forever stocks, but actually holding them forever. Because knowing what to buy is one thing. Having the psychological discipline to never sell, that's something entirely different. Let me tell you about the greatest investment mistake I ever made. Not a stock I bought that went to zero. Not a business I misjudged, but a forever stock I sold. I was in my 40s. I'd owned shares in a particular business for nearly 15 years. Everything we've discussed, this business had it all. Durable competitive advantages that had only strengthened over time. Exceptional management. Consistent growth. Perfect capital allocation. I'd bought it at a reasonable price and watched it compound beautifully. Then the stock price tripled in 2 years. Just exploded higher. And I looked at the valuation and thought, this is expensive. Price to earnings ratio had expanded dramatically. I calculated that forward returns would be modest from these levels. And I made a decision I've regretted ever since. I sold completely. Took my profits. Felt smart. Felt disciplined. Felt like I was being rational about valuation. That was 25 years ago. And you know what happened? That business kept compounding, kept growing, kept strengthening. The expensive valuation I worried about, it proved cheap over the following decades. The stock went up another 15-fold from where I sold. If I'd simply held, if I'd ignored the valuation expansion, if I'd remembered that it was a forever stock, that one position would be worth tens of millions today. Instead, I have regret and a lesson learned the hard way. The lesson: when you find a true forever stock, you don't sell it because it seems expensive. You don't sell it because it's gone up a lot. You don't sell it for any reason except the fundamental business deteriorating, because time is more valuable than price. Compounding over decades overwhelms valuation concerns. The eighth wonder of the world, compound interest, works magic if you let it. But only if you let it. Only if you don't interrupt it by selling. This is the discipline of forever. The psychological strength to hold through everything. Through price increases that make the stock seem expensive. Through temporary declines that make you question your judgment. Through years of underperformance when other stocks are soaring. Through market crashes. Through recessions. Through changes in market sentiment. Through everything except fundamental deterioration in the business itself. Let me be specific about what constitutes a valid reason to sell a forever stock. Because there are legitimate reasons. Not many, but they exist. Reason 1, the competitive advantage is eroding, not temporarily under pressure, but fundamentally, permanently eroding. New competitors are taking share and there's no response. Technology is making the business model obsolete. Regulatory changes are destroying the moat. When the durable advantage becomes not durable, sell. Reason 2, management integrity has been compromised. Accounting fraud discovered. Executives enriching themselves at shareholder expense. Capital allocation becoming destructive. A board that won't hold management accountable. When trust is broken, sell. Reason 3, the industry itself is entering permanent decline, not cyclical weakness. Permanent structural decline. The way newspapers faced permanent decline as the internet emerged. The way video rental faced permanent decline as streaming emerged. When the tide is going out forever, sell. Those are the reasons. Not price going up. Not wanting to take profits. Not fear during market crashes. Not reading negative analyst reports. Not quarterly earnings misses. Not temporary business challenges. Only fundamental. Permanent deterioration in the business quality justifies selling a forever stock. Now, I need to address something uncomfortable. Something most investment advice ignores. The psychological and emotional difficulty of actually executing this strategy. Holding forever stocks requires you to be different. Dramatically different. From everyone around you. From the financial media. From most investment professionals. From your friends and family. They'll think you're foolish for not taking profits. They'll question your judgment when stocks drop. They'll tell you about the hot stocks you're missing by holding boring old positions. They'll mock you when your forever stocks underperform for years. And you must have the strength to ignore all of it, to trust your own analysis, to believe in your own research, to stay committed to your own principles. This is lonely, isolating, difficult. Most people cannot do it. They need validation. They need agreement. They need to feel like they're part of the crowd. But forever stock investing requires independence, contrarian thinking, the willingness to be proven right slowly rather than dramatically. I've held stocks that underperformed for 5, 7, even 10 years. Stocks that just sat there doing nothing while everything else was soaring. And people would ask, why are you still holding that? Don't you see it's not working? Shouldn't you sell and buy something better? And I'd look at the business. Was it still excellent? Yes. Were competitive advantages intact? Yes. Was management still executing well? Yes. Was the long-term trajectory still positive? Yes. So I held through the underperformance, through the doubt, through the criticism, and eventually, inevitably, those stocks caught up and surpassed. The business quality eventually got recognized. The compounding eventually showed through. But that period of underperformance, that's where most investors fail. They lose faith. They lose patience. They sell right before the breakthrough. They abandon forever stocks just before they prove why they're forever stocks. Don't make this mistake. If the business quality hasn't deteriorated, if the fundamental story hasn't changed, temporary underperformance is meaningless. It's noise. It's an opportunity to buy more if you have capital, but it's never a reason to sell. Let me tell you about something I call the paradox of forever stocks. The paradox is this: the longer you hold them, the more reluctant you become to ever sell them. When you've held a stock for 3 years, selling feels possible, reasonable. If conditions change or opportunities arise elsewhere, you might sell. The attachment isn't that strong. But when you've held a stock for 20 years, 30, 40 years, selling becomes almost impossible. Not just because of tax consequences, though those matter, but because of psychological attachment, because of proven history, because that stock has been with you through so much, through marriages and divorces, through career changes, through children being born and growing up, through market crashes and recoveries. That stock becomes part of your identity, part of your story, part of your life, and selling it feels like abandoning a friend, like betraying something that served you faithfully for decades. I have positions I've held for over 30 years, positions that have compounded into amounts that could change my life if sold. But I cannot imagine selling them, not because I need them for income, not because I think they'll outperform everything else going forward, but because they're companions, partners, parts of my investing life I cannot separate from. This might sound irrational, but it's actually deeply rational, because that reluctance to sell, that emotional attachment, it protects you from the greatest enemy of compound wealth activity, trading. The temptation to do something when doing nothing is optimal. So as your forever stocks become true forever stocks, as they age alongside you, as they become positions you've held longer than you've lived in your house or worked at your job, embrace the reluctance to sell. It's protecting you. It's ensuring that compounding continues uninterrupted. Now let me give you practical guidance on building a forever stock portfolio, because knowing the principles is one thing. Implementation is another. Start small. Don't try to build a portfolio of 20 forever stocks immediately. Start with 1, maybe 2. Businesses you understand deeply, that you've researched thoroughly, that meet every criterion we've discussed. Buy them at reasonable prices and commit to holding them for at least 10 years. 10 years is the minimum time frame for a forever stock. Anything less and you're not really giving the strategy a chance. 10 years lets you see how the business performs through different economic conditions, how management handles challenges, how competitive advantages hold up, how the compounding actually works. After 10 years, if the business has remained excellent, if all your reasons for buying have proven correct, extend your commitment to 20 years, then 30, then forever. But don't rush. Don't try to identify 10 forever stocks next month. Take your time. Be selective. Wait for the right businesses at the right prices. Building a forever stock portfolio is a multi-year, multi-decade process, not something to complete quickly. And here's something important. You don't need many forever stocks. 5 to 10 exceptional businesses, held for decades, will create more wealth than 50 stocks traded actively. Concentration in the best ideas held longest beats diversification across mediocre ideas. So be patient in selection. Be demanding in criteria. Wait for truly exceptional businesses at reasonable prices. And when you find them, commit fully. Size those positions meaningfully. Give them the weight in your portfolio they deserve. Another practical consideration: dividend reinvestment. Forever stocks often pay dividends, modest dividends usually, 3, 4, maybe 5% yields. And what you do with those dividends determines a significant portion of your long-term returns. Reinvest them. Always. Automatically. Without thinking about it. Set up dividend reinvestment so that every dividend buys more shares without your involvement. This creates a compounding effect beyond just the business growth. You're accumulating more shares continuously, and those shares generate more dividends, which buy more shares, which generate more dividends. For decades, I have forever stocks where dividend reinvestment over 30 years means I now own 4 times as many shares as I originally purchased, and each of those shares has appreciated. So my position is worth not 4 times my initial investment, but 12, 15, 20 times, because the share count compounded and the share price compounded simultaneously. This is the magic of dividend reinvestment in forever stocks. But it only works if you commit to it. If you set it up and forget about it. If you let it compound undisturbed for decades. Now, let me address something that worries many investors. What if you identify a forever stock, hold it for years, and then realize you were wrong? What if the business deteriorates? What if your analysis was flawed? This happens. Not often if you're selective. But it happens. And when it does, you must have the humility to admit the mistake and the courage to sell. I've held forever stocks that stopped being forever stocks. Businesses where competitive advantages eroded, where management changed and the new team destroyed value, where industries evolved in ways that made the business model obsolete. And when I recognized these changes, when I honestly assessed that the business was no longer worthy of holding forever, I sold, despite the tax consequences, despite the emotional attachment, despite having held for years or decades. Because clinging to a deteriorating business out of stubbornness or denial, that's how investors destroy wealth. Pride becomes more expensive than any tax bill. Attachment becomes more dangerous than any market decline. So here's the balance. Commit to holding forever, but only as long as the business deserves it. Be stubborn about temporary challenges. Be flexible about permanent deterioration. Know the difference, and have the wisdom to act accordingly. This requires honest self-assessment, regular evaluation, not of stock price, but of business quality. Every year ask yourself, if I didn't already own this, would I buy it today at current prices knowing what I know about the business? If the answer is yes, enthusiastically hold. If the answer is maybe or probably not, investigate further. Has something fundamental changed, or are you just tired of the position? If something fundamental has changed, if the business quality has deteriorated, sell. Accept the mistake. Move on. Find a better forever stock. Let me tell you one final story. A story that encapsulates everything we've discussed. A story about the power of identifying forever stocks and actually holding them forever. There was a man, we'll call him James, a teacher, modest income, careful saver, started investing in his late 20s with small amounts, a few $100s a month. But James understood something most people never learn. He understood that wealth comes not from trading actively, but from owning exceptional businesses forever. So he spent years studying businesses, reading annual reports, understanding industries, developing judgment, and over a decade, he identified 5 businesses he believed were forever stocks. 5 businesses with every quality we've discussed. He bought them with his modest savings, and then he did nothing. He never sold. Not when they went up dramatically. Not when they dropped in crashes. Not when people told him he should diversify more. Not when financial advisors suggested more active management. He just held. For 40 years, he reinvested every dividend. Never touched the positions. Let them compound completely undisturbed through his entire working career. When James retired at 68, those 5 positions, bought with perhaps $150,000 of capital over a decade, were worth over $11 million. $11 million. From a teacher's salary. From modest, consistent investing. From identifying 5 forever stocks and holding them for 40 years. From doing nothing except letting compound interest work its magic. James wasn't brilliant. He wasn't lucky. He didn't have special access or insider information. He just understood the principles we've discussed today, and he had the discipline to execute them. That's the power of forever stocks. That's what happens when you identify exceptional businesses and actually hold them forever. That's the wealth that's available to anyone willing to be patient, disciplined, selective. You don't need to be wealthy to start. You don't need to be brilliant. You just need to understand what makes a business worthy of holding forever. And then you need the psychological strength to actually hold it. That's the secret. That's the wisdom. That's the path to generational wealth.